Alright. Hello everyone, welcome to chapter 4 in 5 of CPI. Now, in these chapters, we'll discuss time frame alignment and time frame selection. It's one of the least talked about and at the same time one of the most important topic. No one really talks about it or gives it that much significance, but when it comes to CRT or ICT trading, it's one of the key concepts that leads to a logical trading framework. Without the correct time frame alignment and time frame selection, you won't be analyzing the charts with an optimal performance, right? No matter how good other parts of your technical analysis are. Therefore, you must know about the correct time frame alignments and correct time frame selection and use them in the correct manner, both logically and conceptually. So, in these chapters, I'll make sure to cover everything about time frame alignment and time frame selection that there exist. And after watching this video, you won't have any confusion left about time frame alignment, right? Now, the reason why CRT works so good and has such an unbelievable amount of accuracy and precision is because of this concept right here. All these other concepts work cohesively together because of time frame alignment. It's actually this concept right here which inherently integrates all these other concepts and make them meaningful and rational. Okay, so let's get in the video now. So the first thing that we're going to discuss is time frame selection, right? Now with this concept, you're going to get to know what every higher time frame is used for and what is the purpose of every higher time frame, right? That way you can use these higher time frames in the most efficient way possible and use it in a way that suits your style and your mental capabilities the best, right? So inside higher time frames, the first one we've got is the monthly chart, right? Or the monthly higher time frame. Now, the monthly time frame inherently is used for position trading, right? Position trading is the type of trading where you trade ranges on the monthly time frame. But as we all know, it takes a whole month to form just a single candle on the monthly time frame, right? And you know, most of us don't have the ability to wait for that longer for our setups to form, right? And you would have to wait for years for your setup to form. So the monthly time frame is just for position trading, but that doesn't mean that we as an intraday traders or swing traders aren't going to use the monthly time frame. We're still going to use it to farm a higher time frame directional buys or to have a better understanding of what price could potentially do in the future and what is the higher time frame telling us, right? We're going to still use the monthly time frame even though it's used for position trading, so we can have a better perspective of what the market is trying to tell us, right? Now we're gonna delve on it later in the video, but let's get into the other types of trading. Now, position trading is mostly done by big institutions, hedge funds, or big firms who got a lot of money and their liquidity is pretty large, right? So their orders are mostly executed on the monthly chart or the monthly time frame because of spread, slippage, and all of these other things. But that's not our concern because we are retail traders and we're mostly either intraday traders, short-term traders, or swing traders. That's our main concern, right? Now, another hard time frame we've got is the weekly chart or the weekly time frame. Now, the weekly chart is inherently used for swing trading, and swing trades usually form either once or twice a month, and you're basically trading the weekly range or the range on the weekly time frame, right? But as I said before, even as an intraday trader, we're still going to use the weekly time frame to refine our buys and to determine a drawn liquidity on the higher time frame. We're going to first do that on the monthly time frame and then we're going to refine that on the weekly time frame through a top-down approach through different concepts, and we're going to reach a conclusion regarding our directional buys that we're going to have as an intraday trader or short-term trader. Now, as I said, it doesn't necessarily mean we're going to strictly trade in that particular direction on the lower time frame, because on the lower time frame we can even have some counter trend trades that we can take. But for the most part, if you just stick to the direction of the weekly and the monthly time frame, then it will offer you only high probability trades, right? Now, you might be wondering, why am I telling you about all of this? But there's a proper logic behind it, right? And I'm going to discuss that in detail in just a minute, but before that, let's discuss the rest of the higher time frames. So the next one we've got is the daily chart, and if I'm being honest with you, it's one of my favorite higher time frame, right? And if I had to choose a single one, or if I had a gun to my head to choose a single time frame, that would be the daily chart or the daily time frame. Now, the reason why daily time frame is so important and has so much significance is due to the fact that it's a time frame which suits both intraday traders and short-term traders, right? Doesn't matter if you are a short-term swing trader or an intraday trader, the daily chart will offer you assistance in finding the correct down liquidity and the correct directional buys, right? And you're gonna do that with concepts like everyday data ranges, daily ranges, CRT, market profiles, and key levels, and so on, right? You're gonna use all of these concepts together and integrate them with each other in a logical framework that I've shown you. I've only shown you about market profile and key level till now, but in the next levels of CPI, we're gonna discuss all of these concepts together, and in the same way I've taught you these concepts like market profiles and key levels, we're gonna integrate all these other ones too in a logical framework with a if and then logic, right? And we're going to use them in a system to that they could help us and finding the correct drawn liquidity and the correct directional buys on the daily chart, right? We're going to do that later in CPI. Now, the daily time frame or daily chart is one of the most optimal time frame for intraday trading and short-term trading. Your job as an intraday trader is to trade the daily candles range, right? And try to position yourself and that particular directional bias and that particular drawn liquidity. Now, last but not least, we've got the 4 hour time frame, right? Now, for 4 hour time frame or less, it's used for intraday trading or scalping, right? Most of your analysis is going to be done on this time frame as an intraday trader. You're going to find your higher time frame key levels on this time frame. You will have to match your higher time frame key levels with the CRT on the 4 hour time frame, and most of your work is going to be done here. So your aim should be to get to know the 4 hour time frame as much as possible and as much as you can, and master all of its intricacies and all of its different subtle details. Now, another part of time frame selection is defining your model, right? Now, my job as a coach is to just explain each one of them to you and explain every one of them in detail so that you could get to know them better. And then it's your job to decide for yourself which approach or which trading style suits you the best, right? Now, I've already done my self evaluation and I already know myself that I've got a swift and quick and aggressive personality, and I can look at charts for longer, but I can't hold trades for longer. And the way how I got to know myself this way is by actually monitoring my performance and monitoring my behavior and my emotions when I'm holding trades for longer. And what I found out is that I can't actually manage my emotions when I'm holding trades for longer than a day or a week, and that messes up with my emotions and messes up with my performance. That's why I've got to know through hard work, through monitoring and through self-evaluation, that the style that suits my personality the best is intraday trading, which basically consists of holding trades for just a few hours, and that's the type of style that suits me the best, right? Now, that doesn't mean that those styles of trading don't work or other style of trading like position trading, swing trading, or short-term trading don't work. I don't know how to trade them, but rather it's mostly due to the fact that my mental capability suits a different style of trading, which is intraday trading, right? Now, your job is to try out each one of these trading styles, right? Because if you don't try each one of them, then you wouldn't know how you behave when you're trading different styles of tradings, right? And then when you are trading these different styles of trading like swing trading, short-term trading, position trading, scalping, and so on, what you're going to do is you're going to monitor your emotions and your psychological aspects and see which style of trading offers you the most optimal performance in terms of operating and following your model, right? Now, obviously, in the beginning, you're going to lose with all of these styles because losses are inevitable, and it's these losses which shapes you as a trader. But the point is to monitor your performance as an operator, right? And see how good you are able to follow your plan and stick your plan. And then you're going to compare these results with each other and stick to the one style that offers you the most optimal performance, right? That's your job as a trader. Now, that's something that no one really talks about, right? In trading, the psychological aspect of trading, which is rarely talked about, and that's why most traders lose in the first place and just give up because They don't know that trading isn't just about technicals. It's all about, now it's not all about, it's you got to have a balance between your risk management, your technical analysis, your technical aspect, and even your psychological aspect. You got to have a balance between all of them. And you, if you're just going to focus your attention on just a single one, like just technical analysis, then obviously you're not going to succeed with that. But if you focus all of your attention on just your psychological aspect, and be ignorant to your technical knowledge, then obviously that won't also be end up good for you. That also won't end up good for you, right? So you as a trader must have a balance between all of them, and you have to focus on each one of these aspects for you to succeed as a trader and become consistently profitable. Now, that's the main reason why there are so many different courses. Like there are hundreds and thousands of good trading courses, and almost everyone has watched them, but people still suck at trading. And that's because they haven't yet found it out their style of trading or this approach of trading that suits their personality, right? And not even that, most of these traders haven't even diagnosed this problem, right? So imagine if you don't even know about the problem, then how the fuck are you going to solve that? The first step to solve a problem is to diagnose and identify that problem. And then solving is the easy part of it, right? But people are too stubborn and ignorant to do that because the narrative is that strategy is everything, a model is everything, and the solution to your problem is a new strategy, right? That's what narrative that they are using on Twitter and all of these other social media platforms. But the real thing is that you need to have a balance, as I said before. Now, don't get me wrong, if you don't have a proper system in a trading model, then obviously you don't have a single chance at succeeding. But also at the same time, you have to and you got to look at your psychological mental parts too and focus on them as much as you focus on your technical parts of your trading. And if it was that easy and the solution was just technical analysis, then everyone would be profitable, right? But that's not the case. Not everyone is profitable. And once you realize this part, everything changes for you, right? Now let's get in the video. So the first one is a position trader who basically trades the monthly range, or the range is on the monthly time frame. And as I said before, only firms and hedge funds with huge amount of money, liquidity, and capital, and huge firms have this style of trading. And you won't find a single retail trader having this approach. And the reason for that is simple. A position trader waits for months and even years for a setup to form. And obviously most of us just don't have that amount of patience or mental endurance, right? Now, the second one is a swing trader. A swing trader trades the weekly range and ranges on the weekly chart or the weekly time frame, right? Now, typically for swing trader, their setup takes a few weeks to a few months to form, and then the average duration for their setup also ranges from a few weeks to a month, right, or a month or two. Now, this style of trading uh, works too, but this usually works best in expansion profiles on the weekly chart. And we know that most of the time price is in ranging profile. So that means you'll have to wait for a lot of time to wait for your setup to form and then to execute that setup as a swing trader, right? Another style of trading is short-term trading. A short-term trader trades the ranges on the daily chart. Now, the objective of a short-term trader is to trade the ranges on the daily chart inside a weekly range. And what I mean by that is that inside a weekly candle, we've got 5 daily candles, right? Meaning 5 days. So as a short-term trader, our job is to trade that weekly range on the daily chart and exploit that range. And as a short-term trader, you would be using the daily chart as your higher time frame, and you would be profiling in taking entries on the 1 hour time frame. That's how you're going to use the correct time frame alignment for short-term trading. So moving on, we've got day trading or intraday trading, right? An intraday trader trades the daily candles range, right? Now remember, there's a difference between the two. A short-term trader trades ranges, like complete ranges on the daily chart, Whereas an intraday trader or day trader just trades the daily candles range, like a single candles range, right? That's what I'm talking about here. So your job as an intraday trader would be to trade that daily candle range on a daily basis, and your entries and exits would be within a day. So you won't hold any trades overnight or over the weekends, and your job would be to get in and get out on a daily basis instead of a single day. That's what we call intraday trading, and that's my personal approach to trading. Now, another form of trading, which is an aggressive type, is scalping. A scalper trades the hourly range or the 5 minute time frame or the 1 minute time frame, right? Scalping is a really aggressive type of trading, and the margin of profitability for scalping is pretty small as compared to the other types, right? And it's an advanced type of trading that you need to be pretty quick with your execution and your thought process and in your analysis, right? It's also something you could definitely try and see whether it suits you or not, right? But as I said before, the margin of profitability is quite smaller, comparatively speaking. Now, in scalping, the average trade duration ranges from a few minutes to an hour or two. So these were the higher time frames and their purpose and objectives and what they are used for. And along with that, we also define the different styles and approaches to trading and how they are done on a surface level. Now we're going to move on to another slide and discuss the higher time frame in more detail and what are the purpose that these higher time frames serve. So here we got a monthly time frame, right? And here I've chosen the small price action right here. Now it seems pretty small, but this price action was formed over a year and a half and it has got a range of like 2000 pips, right? Now the monthly chart is the first one and that you're going to start analyzing with, right? It doesn't matter if you're a swing trader, a short-term trader, or any trader, you're going to still start off with the monthly chart to find and determine your directional bias, and you're going to do that with different concepts which we'll discuss. But also at the same time, the monthly chart is going to give you conviction in your directional bias and your drawn liquidity. Now, the monthly chart is actually going to do a lot of assistance for your trading and your analysis, right? Obviously, the monthly chart moves extremely slow, but throughout CPA, you're going to see that the precision and accuracy that I have has had to do a lot with the direction that's derived from the price action on the monthly chart. The monthly chart is our basis for our trading and our top-down analysis. We start right with the monthly chart and find a particular drawn liquidity or direction which we further refine on the lower time frame such as the weekly or the daily. We're comparatively speaking, right? If we compare weekly and daily to the monthly time frame, then obviously they're lower time frame. But in the grand scheme of things, comparing them with the hourly or the 15-minute time frame, obviously they're higher time frame. So everything is relative. There's nothing absolute, right? You have to remember that. Now, as I said before, I'm not a long-term position trader because I tend to change my mind a lot. And I got like an aggressive and swift personality, so I'm more suitable for intraday trading and not position trading because I know that I can't hold trade for much longer and I tend to fuck up if I hold it, right? That's why most of my entries are intraday trades or day trades, and the average duration of them tends to be between 4 to 5 hours, right? This is the thing that no one really talks about in trading. You gotta find a style of trading that suits you the best. For instance, you might see someone who's actually a really good swing trader and holds on to position for weeks and is profitable. And let's say he teaches you his strategy, right? That doesn't mean you're gonna be profitable with it too, because your personality might be different than his. Your mental capacity and your mental capabilities might be different, and it's your job to evaluate yourself, get to know yourself, and really dig deeper into who you are and what kind of behavior and attitude you have, and what is the approach to training that suits you the best. The only person that could do that for you is you and no one else, and you're gonna do that by actually taking trades and journaling your thoughts and your psychological aspect and seeing whether it's causing issues for you or not, or whether you are comfortable with the mental capacity or not, right? Now, the different concept that you're gonna use to analyze the monthly charts in order to come to a conclusion about the directional bias that you're gonna trade are concepts such as quarterly shifts, seasonal tendencies, dealing ranges, key level CRT, and so on, right? Now, quarterly shifts and seasonal tendency are going to help you build a narrative, and you're going to use these other concepts to build a directional bias and frame a trade idea. Now, we still have yet to discuss all these other concepts in detail, but I'm just giving an introduction to them here. And throughout the next levels of CPI, we'll discuss how you can use these concepts to assist you in your higher time frame analysis. Now, as an intraday trader, you're not going to necessarily trade in the direction of the monthly directional buys, right, or drawn liquidity. You're still going to trade setups in the counter direction because we all know that the markets never move in a straight line, right? And it always has ranging profiles and retracements before it reaches its targets, right? So that means, let's say we've got a certain drawn liquidity on the monthly chart that we're looking at, right? Now obviously it's going to take a weeks for price to reach there, and throughout this time price is going to be in different market profiles in the lower time frame. We're going to have retracement, we're going to have ranging profiles, and then expansions, right? We're going to have different market profiles towards that direction. Now the retracement profiles on the higher time frame are still tradable on the lower time frame, and you can counter trade them because on the lower time frame they'll be logically looked at as expansions or reversals, right? So that means inside of a higher time frame expansion there are multiple lower time frame retracement ranges or reversals profiles, right? The higher time frame market profile is made up of multiple and various lower time frame profiles consisting of various types of it, right? We're going to discuss such advanced market profiles in terms of time frame alignment 2 in further chapter, so you can have a better and dynamic perspective to it, right? So the idea is that on the monthly time frame you're going to use these concepts to build a directional bias, and then your long-term directional bias and drawn liquidity would be exactly that, and you're going to stick to that unless there is a change in market dynamics or price action on the lower time frame that tells you otherwise, right? You could also use this as a filter to manage your risk too. For example, if you find an intraday setup or a short-term setup in the directional of the monthly directional bias, then you could regard that setup as an A plus setup or a high probability setup. But if it's in the counter direction, you could comparatively regard that setup as a setup or a lower probability setup, and you could then still trade that setup, but you're gonna just manage your risk on that particular trade accordingly, right? That's exactly how I manage my risk on my intraday setups too. Now let's discuss some price action here on the monthly chart. Now we know that there are different protocols and intricacies for finding and selecting CRT correctly, right? And then using that CRT correctly. But on a fundamental level, the idea is that every single candle is a range, and every single candle can be treated as a range on its own, right? That's like the main statement of candle range theory. Now, when one side of a CRT range or a typical range is purged, our drawn liquidity become the opposing sides, right? Now, we're not going to discuss the different protocols here because we're discussing time frame alignment, and that's a topic for another day. But we're going to keep that fundamental principle of CRT in mind, and we're going to look at this price action right here with that particular perspective. Now, obviously, you need to remember that if you were analyzing this price action in real time, then you would be using all those other concepts as well that I mentioned earlier, and use them together to reach a conclusion or to determine a directional bias. But for the sake of simplicity, we're just going to look at it with a fundamental basic level CRT perspective because we haven't yet discussed all those other concepts yet. So once we discuss them and explain them, right? Once I explain them to you in the later chapters, then we're going to integrate it with these principles right here, and we're going to look at it with a logical framework. But for now, this is what we are going to be working with, right? Now we know that when price engulfs a candle, that particular candle becomes a key level for us, and price use that price action for future reference to react off of, right? Now keeping these two principles in mind, let's look at this price action. So starting off here, we can see that price took out this candle's low right here, and then it closed above and inside that candle's range. So now when price takes a candle's low and then closes inside just before taking out the opposing end of the range, what happens is, starting with the next candle is open, our buys and our drawn liquidity becomes the opposite end of that range, and we started looking at that high is our drawn liquidity and our buys, right? Now in this case right here, you can see the price eventually took this high and closed above. So you can see that for this particular monthly candle right here, for the whole month you would have had a bullish directional buys because the drawn liquidity is high, and for this particular month you would be looking for longs, particularly on a short-term trading basis, right, and day trading basis. And as I said before, you're not just gonna necessarily look for just long or bullish trade, but counter trades too. But the directional priority would have been bullish for you during this month, right? Because the drawn liquidity is high. Now we know we've got like 20 trading days in each month if we exclude bank holidays and other days like NFP and CPI, because we're not gonna trade them, right? So when we exclude those days, you would have 20 trading days to look for longs and potentially exploit this directional buys on the monthly time frame, right? Now you could see that this monthly candle closed above inside this candle right here, right? Now we know that when price closed above a candle's range, what happened is that particular candle is then used for price as a key level to be tested and for price to react off of, right? That's a basic idea of a key level. Now keeping that in mind, when the next monthly candle opens here, what would you be expecting is for price to first of all retrace to the open or the high of this candle right here. So it means your directional buys for the first half of the month would be bearish. So and you would be expecting bearish prices until this candle is open or high is tested, and then your directional buys would again become bullish because now you know that price can find support here and expand higher. So you can see here we are using logic here again and looking at it with a dynamic and logical perspective, right? Now, moving on to the next monthly candle, you can see that we've already tested the previous candle's open as a key level to react off of, and now our directional bias is to expand higher and potentially make another higher high, right? So with the start of the next monthly candles open, you would be expecting higher prices because candles has closed above, and your directional bias would be bullish for the next monthly candle. Similarly, that would be the case for you for the next candle too. And then using the same principle, you see that this was the first time price closed inside a candle's range, right? You can see it right here, and formed a huge wick. And you know what that means? It means that price has now shown bearish signs because first of all, it closed inside the candle for the first time since 3 months, right? Since three monthly candles. And second of all, it formed this huge wick, which is a bearish sign because wicks represent bearish signs, right? Or lack of energy or momentum. So based on these factors, you would then, for the next monthly candle and the next month, you would expect bearish prices, and your directional bias would be bearish and lower. Similarly, again, you can see right here that this candle closed below the open of that candle. And based on the definition of an order block, when such candle which takes out liquidity and takes out a CRT high or a high or test a key level, and then such candle when it gets engulfed, it becomes what? It becomes a bearish order block, right? So with that in mind, with the next monthly candles open, we would start looking for that candle to be retested, and then we would look for price to expand lower from there, and our buys and our drawn liquidity would be towards this monthly candles range low or CRT low right here, and you can see price exactly did that. Similarly, with each monthly candle, you're going to look at it with the same logical perspective and principles, and you're going to determine your directional buys for the month, and that will assist you in your trading, and that would be really helpful for you. That is going to increase your accuracy and precision by a huge margin, right? If you analyze the monthly price action. Now remember, we are just using only two logical principles right here to analyze the price action and the monthly chart, right, in this video, and we haven't even used the other concepts yet, and still it works so good. Now imagine when you learn about the other concepts and you integrate those ones with this logical framework, Now imagine how much it will assist you in finding a directional buys on the higher time frame, on the monthly time frame, right? That's the power of CRT in a logical framework, right? That's what's happened when you look at price action with a logical perspective instead of a perspective that is predominantly based around patterns. Because I know everyone knows, everyone that is profitable knows that patterns don't work. What works is finding a correct narrative through a conceptual and contextual logic, and then having a framework that is based on logic, and then framing trade ideas through the help of those aspects, right? That's how successful and profitable trading works. Now, I'm analyzing this price action right here with only these two principles because we haven't yet learned and discussed the other concepts yet, right? But as we move on to the next levels of CPI, we're gonna start learning about those other concepts, and we're gonna start integrating those concepts with these logical principle right here in a logical framework, right? Now, again, moving on to the next price section, we can see again the next candle opened and formed a ranging candle and closed inside this big bulky candle right here and formed a wick too, right? Now, again, another interesting thing is that this candle right here also tested the original candle that we started off, right? So this monthly candle was a ranging candle. It closed inside, which shows bullish signs, right? And it also formed a wick, which enhances the bullish scenario even more because a wick represent lack of momentum, lack of energy. In this case, it's representing bullish signs because we've closed inside and we formed a wick, right? So based on these factors right here, you're going to start looking for bullish trades as soon as the next month's candle is open, and your directional buys would be bullish, right? And your drawn liquidity would be this high right here, right? Now, as a homework for you, I want you to tell me how you would analyze and reverse this price section right here with the same logic. You're going to use the same logic and make sure to send it to me, and I'll give you my feedback on it and whether it's correct or whether it's wrong, right? So that was it for the monthly chart. You saw how you're going to use this monthly chart to assist you in finding a particular directional buys, and how you're going to use monthly chart to find your buys and drawn liquidity, right? We've just discussed basic level technical knowledge right here, but this alone is more than enough to assist you for the time being, right? And moving on, we'll integrate other concepts and logics with it too. Now, let's move on to the weekly chart and look at that same price action with the weekly charts perspective. So, you can see that these significant highs and lows right here where price made these reversals and these expansions, these highs and lows are the monthly CRT highs and low that I just showed you before, right? Now, right here you can see that it's the monthly candle, right? And price purged this low with this candle, and then it closed above and inside of this range right here. So for the next weekly candle open, you would be expecting higher prices till the opposing range high is taken, which is this high right here. And you can see right here for the next few weeks, we kept pushing higher, and our directional buys for the time being was bullish. Then after price action closed above this high right here, this high became a key level for us because this high led to taking out liquidity, right? And now price is going to use this high as a key level and tests it and expand from here. Such high are called what? They are either called mitigation block or breaker block, right? So for the next week, you're going to expect price to retrace to this key level and then find support there and expand from there. Now remember, each one of these is a weekly candle, right? So you can see that you've got 5 trading days inside each weekly candle to trade, uh, right? And you've already found your monthly's directional buys, and now you've refined it even more on the weekly candle, and now you're gonna trade on those 5 days and that particular directional buys that you've determined or that you found through this analysis right here, right? And you can see right here, if your logic and narrative was correct, you would be right for all these weekly candles, and your buys and your drawn liquidity would be better than most traders, and you would have had a better precision and accuracy in terms of directional buys than anything else, right? Now, trading them on the lower time frame is a different topic in itself, and we're going to discuss that. But in terms of directional buys, you would have a really high precision and accuracy if you determined and if you use these price action right here in this way on the higher time frames, right? Now, again, right here, looking at this price action, you can see that once we tested this key level right here and retraced to this key level, for the next week we would expect bullish candles and bullish prices in the opposite direction, and we would look for price to expand from here, right? Now with this candle right here, you can see that price expanded higher, and then with this expansion above and closed above this candle. Now what that means is now we can use this candle as a support or a key level, and price is going to test that and expand higher from here, because we know that close above represent bullish prices and close below represent bearish prices, right? Similarly, again, when price closed above this high, again it again tested and formed this FVG and then filled that FVG and expanded high. Then what happened? We formed this monthly CRT, we went above and then reversed from there and closed inside that CRT. So our directional buys would then become bearish towards the monthly CRT low, which is this low right here. So you can see again, using the same logic over and over again, you can see the rest of the price action here again with that perspective, right? Now I'm 100% sure that you are already looking at this price action with a different perspective, right, than what you had before when you started this chapter, right? And that's the exact purpose of these chapters, to make sure to explain these complex and advanced concepts in such a way, in such a simple way that everyone understands it, right? That's my goal with these chapters. Now, as I said before, the daily chart is mostly used by short-term traders and intraday traders, right? And you're going to use the same concept here again to analyze this price action and reach a conclusion regarding your directional buys for the day. You're going to refine all that analysis that you've done on the monthly and the weekly chart and refine it down to the daily chart, right? And use it to assist you in finding a directional buys, right, or a drawn liquidity. Now you can see there is a logical process and framework for how you're gonna do that, and I'll even make a separate chapter for that. But for now, I'm just explaining the purpose of every different higher time frame here, right? And you just saw it yourself. We're gonna use concepts like CRT, dealing ranges, CRT market structure, order flow, EBITDA data ranges, weekly profiles, market profiles, and so on to analyze price action on the higher time frames such as the weekly, the monthly, or the daily chart, and then reach a conclusion. Now, your purpose as an intraday trader would be to determine your directional buys for the day and then trade in that particular direction, right? And predict and anticipate where the daily candle is potentially headed to or where it's going to potentially close, right? That's your aim as a trader. Now these were all the different functions of each higher time frame, ranging from the monthly down to the daily time frame, right? What you should do is note all of these down and note all of its characteristics that I just told you about, and then remember what is the purpose of each time frame and what is the purpose that each time frame serve, right? Next one we've got is time frame alignment, right? As I said before, it's one of the most important concepts when it comes to CRT or ICT trading, right? And the way how CRT and all of these other concepts work so accurately and precisely is due to the correct integration of them through time frame alignment, right? So if you don't know how to align time frames correctly, then you wouldn't be able to integrate these concepts together in the most accurate way possible, right? So in order to learn how to integrate these concepts together, you must know about the correct time frame elements and the correct combinations of time frame elements. So let's discuss time frame element. So for each style of trading, there's going to be three main active time frames and other passive time frames, right? Now it doesn't mean that these are going to be the only one you're going to use. You're going to still use other higher time frames too, but on a basic level, you should stick to these main active time frames, right? If you're a beginner. Now we've got the higher time frame, the intermediate time frame, and last but not least, the lower time frame. Now the higher time frame is going to be used for two functions: for finding CRT and for finding key levels, and then merging them together and integrating them together. That's what the higher time frame is going to be used for. Then we've got the intermediate time frame, on which we'll determine structure and order flow. And structure is basically seeing whether price is breaking highs and rejecting lows, or it's rejecting highs and breaking lows. That's what we call structure on a fundamental level. We're going to discuss structure in detail too in other chapters, but on a fundamental level, that's what we regard structure as, right? Then we've got the lower time frame, which will be used for two functions: for profiling the market, meaning using market profiles to expect or anticipate other profiles, and then using the lower time frames for taking entries and finding entry setups. That's where you're going to execute your trades on. So these are going to be the three main time frame we'll use for our particular side of trading. Now let's discuss some different time frame elements for different style of tradings, right? So the first one we've got is swing trading, right? So for swing trading, our higher time frame will be the monthly chart or the monthly time frame, and we're going to use it for two functions which I mentioned before, which is marking out key levels and finding CRT. And then we've got the daily time frame, which will be our intermediate time frame, and we're going to use it for determining structure and order flow, right, through different concepts. And then last but not least, we'll be profiling the market and finding entries on the 4-hour time frame, which will be our lower time frame for swing trading, right? So for swing trading, these are the main time frame that they'll use to accurately and correctly do a top-down analysis, right? This is how you're going to do your top-down analysis as a swing trader. And next one we've got is short-term trading, right? And for short-term trading, we've got weekly is the higher time frame. We're going to use the weekly chart to finding key levels and finding CRT and then matching them together. And then we've got the 4-hour time frame as our intermediate time frame to determine structure correctly. Now, one thing you need to remember is that we're not talking about conventional market structure here, right? And conventional market structure shifts because those things don't work. We're going to determine market structure in a complete different manner with a logical framework, which we'll learn that in a different chapter. But for the time being, let's discuss time frame elements for now. So the 4-hour for structure, and then we've got the 1-hour time frame for our lower time frame entries and profiling, right? Next one we've got is intraday trading. This is my personal style of trading, and this is how I trade, right? Now I don't want to force a certain style of trading on you, and as I said before, you should find your style of trading on your own by experiencing each style of trading and self-evaluation, right? So that's up to you. So for intraday trading, we've got the daily and the 4-hour time frame is our higher time frame. I specifically use the 4-hour as my higher time frame, but when price action is not clear, then you can use the daily time frame as an alternative too. So you could see the bigger picture. And then we've got the 1-hour time frame for structure. It's our intermediate time frame. And then last but not least, our lower time frame for entries and profiling the markets is the 15-minute time frame, right? Now, what you need to remember is that even as an intraday trader, you still are going to use and analyze the monthly chart, the weekly chart, and the daily chart, because that's going to provide you with a higher time frame perspective and a higher time frame directional bias. But your main time frames as an intraday trader will be these three ones right here, right? Then last but not least, we've got scalping. for that style of trading, the correct time frame elements are the following. You can read it right here. So moving on, here is a graphical representation of how time frame alignment looks like. So we've got the three main time frame, which are the higher time frame, lower time frame, the intermediate time frame, right? So again, remembering the purpose of each one, you could see that the higher time frame will be used for two functions: marking out key levels and finding CRT, and then matching them and integrating them together. Then you'll use the lower time frame for determining structure in gaining conviction in your analysis, and then the lower time frame which will be used for, you guessed it right, profiling and entry setups, right? You're gonna use all these time frame and a logical framework with each other and gain insights into a better understanding of the market through this approach, right? Now let's say we are scalpers, so for us the higher time frame will be the 15-minute, intermediate would be the 5-minute, and the lower time frame would be the 1-minute time frame. That's how you're gonna use them. Now let's go over some charts and let me give you some example of time frame elements. So I'll give you an example of time frame elements on of intraday trading, right? So let's start off with that. So you're gonna do all of your higher time frame analysis and determine your directional buys on the multi time frame, the weekly, and the daily time frame, right? And then come down to the 4-hour time frame and refine all of that analysis down to the 4-hour time frame to frame a trade idea either towards that directional buys or counter to that directional buys, and manage your risk accordingly based on those factors. So the main higher time frame for intraday trading is the 4-hour, right? Here we would be finding our key level, right? And also we would be matching that key level with a CRT, and then we would move on to the intermediate time frame to determine structure and add the time factors to it. And then last but not least, we will take our lower time frame entry and based off of the profiling, right? So right here on the 4-hour, you can see that we've taken out this high right here and in the form of our key level, right? If you've been watching my trade breakdowns, then you'd know that I took an entry here, right? And you'd know exactly why I took an entry here and why did I expect price to retrace from here. But for the lazy one that haven't watched it yet, let me explain it to you. So what happened here is we had this expansion once this range low was taken, right? And now we know that once range low is taken, our drawn liquidity becomes the 50% of that range, and then eventually opposing at end of that range, right? Now before we move on and expand higher again to take out the opposing end of the range, we have to have a retracement first, because that's how price moves, right? Price doesn't move in a straight line. Even if the drawn liquidity is higher, price is still gonna have these retracement before it eventually moves higher and takes out the range high. And the second factor is that we've taken out an inside range high during the New York kill zone, and the New York kill zone and the London close kill zone, and such scenarios tend to be either reversals or retracement, right? That's why I expected price to retrace from here on the daily basis, right? So in this case, I expected a retracement on the higher time frame, which is going to be a reversal on the lower time frame, right? So for that, I try to first match it with a key level on the higher time frame 4-hour, which is this high right here, right? And second, we have this CRT, which I matched with this key level, and the two function that I was supposed to do on the 4-hour time frame were done and finished, right? That was my higher time frame thought process. Then I moved on to the intermediate time frame to determine structure and also add time factors to it, right? And so look at the price action with a more refined perspective. So here on the 1-hour time frame, you can see that if we add the opening times, right? Here the 17 Eastern opening time and then the closing time, you can see that we had a ranging profile straight away after price opened, and then an expansion, and with this expansion right here we took out these equal highs, and we did that during the second half of the day. Now based on structure, even if our higher time frame dollar liquidity is higher, we still can expect price to retrace before moving higher. Now there's a lot more intricacies and details into structure which we'll discuss, but this is what the thought process for this day right here was, and this is how I gained conviction in my trade idea. Then I moved on to the 15-minute time frame for profiling and entry setup. So let's move on to the 15-minute time frame. On the 15-minute, you can see that you can see these different profiles here, right? We've got this ranging profile, then this expansion profile, then this retracement profile before expanding higher again. And with this expansion profile right here, the last one, we tested a key level in the form of a 4-hour inside range high. Now based on market profile and the key level integration, the only possible outcome after price test a key level with an expansion move, the only possible outcome after that is a reversal profile, right? So based on these factors, I expected a reversal. But obviously I couldn't just short right away, right? I had to first wait for a confirmation and wait for my entry model, which is basically a model 1 entry which formed right here, and I traded that. This is how you use time frame alignments in the correct way. And in this video I explained the different time frame alignments. I explained how you can use the correct time frames for your trading, for your style of trading. I explained different style of trading to you. I explained and defined different models to you, right? What are the different styles of trading? This was chapter 4 and 5. Hope you've enjoyed it. Hope you've made notes, because that's how you learn as a trader and you evolve as a trader, right? Thank you.